Welcome back to my channel. In our last video, we talked about the key reality check and how to use projections properly for pre-revenue startups.
For the professional reports and investment committees. Fine. Now we will talk about the venture capital method. Okay, so venture capital method, how we'll calculate, what we'll use it. Okay, this method when you have some kind of revenue. So this method will apply. So since your client has only projection, here is how to use them correctly. Venture capital method, projection based investor style, because you have some kind of revenue projection. Okay, steps simplified. Fine, you can see over here. So estimate 5-year revenue, that's need to do first of the thing. Then apply industry exit multiple. It means VC method will be calculated that, okay, after 5 years, what would be the value of your company? And then you need to discount it back today to get the pre-money valuation. And that would be the value of the company. And then you need to allocate accordingly with respect to your circumstances. Fine. So if you'll assume that, okay, what would be the formula? EV to revenue or EV to EBITDA, both it can be used. Fine. Estimate exit valuation. Okay, so exit valuation, probably you can think that, okay, after this 5 year, probably it could have the 120 million value of the company. Then you need to discount it back to, as of today, by taking the 4-year 5-year span as a discount rate, and then we'll get the value discounted back, very high discount rate, 40 to 60%, not less than that, because it's a high risk venture capital. Fine. Now the example has been given. It means year 5 revenue would be 40 million. Exit multiple would be 3. Then the exit value would be 120 million. Discounted back to the present value 7.5 million. Okay. And then less future dilution, pre-money valuation, that would be your 6 to 7 million. Okay. So this method legitimates the projection without overstating stating the today's value. So the probability, the next is DCF method. It means DCF method normally applicable to those companies who have a very high growth companies. Fine. So now you need to clear it, make it very clear. This is so do not rely on classic DCF alone for pre-revenue startups, because you need to add some more methods. Okay, along with the scorecard method, checklist method. So you need to add the VC and this method DCF as well. And thereafter that 4 to 5 method averages, then you can come up with the valuation. Not only you need to apply on the pre-revenue companies as a DCF method. This is please make it very clear, because these are the totally misunderstanding in the market, which the prevailing in the market, the people, they are not getting understanding, even though in the after 6 months or 1 year they will do the company valuation based on only DCF, which is totally wrong. Fine. If you want to use it, you can use it for the multiple scenario, base case, upside, downside, apply probability weights. Okay, you discounted 35%, clearly market supporting analysis only. Fine. So hopefully, okay, so now if we will decide that, okay, which method would be suitable for what, okay, that means we need to analyze or categorize. Traditional DCF, okay, that would be not suitable if you don't have the the historical cash flows. If you have, then it would be applicable. Next is asset-based valuation. So you will ignore the IPs, intellectual property, team, or growth. Okay, then it would not be not applicable. P multiple, if you don't have the earning, then it will not be applicable. Book value, meaningless for the sport, because startup companies, they don't have the assets too much, so that's why it's useless. So you can what you need to do. So you need to mention these all methods so that you can understand that which method would be applicable for what in which circumstances. The first of all, recommended method, it means first of all what you need to apply. So you need to give the 4 to 5 methods. So in that way, the primary method would be your scorecard method, Berkus, or I would recommend make it checklist method. Secondary method would be, the VC method or projection based method, the risk factor estimation method. And for the sport only, you need to use a DCF. So this will enhance the credibility, okay, of your investor, banks, and regulator. By combining all these methods, you will come up with the valuation very, very nice. So now, what does it mean by no revenue? Definitely, it doesn't have revenue, single day. You can say at this stage, the valuation reflect the future potential, market opportunity, team capability, and execution readiness, rather than the past performance. Early stage investor price risk, not history. This reassures them without inflating the expectation. That's it. So this was the just idea of the startup valuation. We will discuss in detail in the part 2 in more detail, and I will explain to you how we calculate the scorecard method, checklist method, VC method, and DCF method. Fine. And in that way you will get the better idea. Okay, so let me show you how the report of the startup valuation will look like. Probably you will get the better idea. Fine. So let me show you the sample of the report. So here is the sample of the report which I need to show you. Okay, let me make it zoom, and then you will get the better idea. So this is the startup valuation report. Okay, this is a disclaimer. Find the purpose of the company, startup valuation. Okay, so you can see over here. Fine. So this is a startup summary. Fine, because these are the three methods. Fine. You can see the scorecard method, checklist, venture capital, free cash flow, market multiple. Fine. In that way, we need to calculate this one. Okay, the company profile. You can see the company profile we need to mention. Fine. And this is the team profile. Fine. So you can see over here. Fine. Industry market analysis. You can see over here. Fine. SWOT analysis. Okay. Competitive analysis. Fine. This one is start evaluation. If you'll see that how the method we need to categorize the if you'll see the scorecard method, checklist method, venture, DCF with the long term and DCF with the multiple approach as well. Seed stage, early stage, growth and expansion. We need to categorize in such a way the information will look like better. Fine. So this is the format of the report we will give to our client. Okay, so we'll discuss in detail once the client will request from us, and we will have the meeting to show them that how we have computed and how it can be computed. Okay, so all the methods we need to mention the each and every detail, how it has been calculated and how we have derived. Okay, that all based on the market study. You can see over here. Fine. So this is the risk and mitigation. You can see over here. We need to quantify as well the amount. Okay. So you can see over here 5-year projection. Definitely it would be applicable for the DCF method. Appendix. Okay. So we need to mention this, all these things. Okay. So how we have used the, KVAC. Okay. What would be the beta and all these things. And based on the industry and company growth rate factor. So all these factors we need to see. Along with that, we need to mention the source link from where we have pulled out the data. This is the source link. From our side, we will not put any kind of valuation. Fine. So hopefully you will get, and if you want to contact us, this is our mobile number. Okay, so you can approach us, and in that way you will get the better idea that how we will calculate the startup valuation as I showed you. And even though we in the detail we can show you the report once you will approach us, but for sure you will not less than the quality which is providing by other competitor. We are far above. Fine. Thank you very much. Thank you very much.
That's it for today's video. If you haven't watched the first part yet, where we covered the key reality check and how to use projections properly, the link is right there in the description below. Make sure to check it out. Thank you so much for watching. Don't forget to like, share, and subscribe. See you in the next video.